Hello, I'm Ani from the Central Bank of Armenia and a student at the Better Policy Project. It's my pleasure to host Davit Nahapetyan, a board member of the Central Bank of Armenia. In this episode, we will explore the idea of endogenous money creation. But before diving into that concept, could you please explain the distinction between general money and central bank money?
Certainly. It's crucial to distinguish between the two. General money is created endogenously by the banking system. When banks lend, it flows directly into the economy. On the other hand, central bank money is issued by the central bank through mechanisms like monetization or emission. It serves as the foundation of the monetary system and represents a liability of the central bank. This distinction is critical because unclear boundaries between the two can lead to instability and mismanagement, especially if monetary policies fail to address the nuances.
That sets the stage well. Let's now discuss the essence of money creation. How does the process work?
Money isn't a fixed quantity, it's created dynamically or endogenously. When banks issue loans, they simultaneously create deposits. These deposits, financial liabilities of the banks, function as money in the economy. Unlike older theories that rely on concepts like the money multiplier or pre-existing pools of savings, modern money creation is a near instantaneous response to economic conditions. This makes the process incredibly powerful, but also potentially dangerous. Traditional textbooks often present an outdated notion that banks lend money only from the deposits they collect. While intuitive, this model fundamentally misrepresents modern banking. In reality, lending itself generates corresponding deposits, effectively creating new money. This misunderstanding persists partly because the process of endogenous money creation is complex and difficult to explain in practice. As Douglas Laxton points out, this reflects a lack of intellectual discipline in critically analyzing monetary mechanisms. Meanwhile, Bill White has suggested that the issue also lies in operational discipline. He has even proposed revisiting the idea of a narrow money regime, not to implement it outright, but to assess its potential benefits for simplifying the system.
Are there any risks related to endogenous money creation?
Endogenous money creation has its dark corners. Its speed and scale make the system inherently vulnerable. In periods of optimism, money flows freely, fueling economic growth. But when risks are suddenly reappraised, the system can reverse rapidly. Credit contracts, deleveraging begins, and the economy risks recession. These vulnerabilities are often the starting points for financial instability.
Can you provide some specific examples of these vulnerabilities?
Sure. First, asset prices. Take the Chinese housing market, for example. When housing prices significantly outpace household incomes, the system becomes fragile. If these prices fall, the collateral underpinning loans loses value. Banks then tighten lending, slowing or reversing money creation. Second, credit to GDP ratios. Excessive credit relative to GDP is a red flag for financial vulnerabilities. While traditional tools like the HP filter might underestimate these risks, policymakers must be vigilant when credit growth exceeds safe levels. This can push the economy into unsustainable territory.
What happens when these vulnerabilities materialize?
When the system breaks, the consequences can be severe. Banks tighten lending, and money isn't just withheld, it's destroyed as loans are paid off or defaulted upon without replacement. This can deepen recessions, as seen during the global financial crisis. Falling housing prices led to a credit crunch, widespread deleveraging, and a severe economic contraction worldwide.
How might central bank digital currencies, CBDCs, address some of these challenges?
CBDCs could provide a new framework for stabilizing the monetary system. They represent a response to the growing influence of non-financial private entities creating money through blockchain technologies. These innovations exist outside traditional banking and central bank control. By issuing CBDCs based on the blockchain technologies, central banks could reassert influence over the monetary landscape, ensuring money creation, distribution, and payments remain traceable and manageable. This would help maintain financial stability while adapting to an evolving financial ecosystem.
Fascinating insights. Thank you for clarifying these complex topics.
My pleasure. It's been a valuable discussion on understanding and addressing modern financial vulnerabilities. For more insights, feel free to explore additional videos about endogenous money creation on the Better Policy Project YouTube channel. Don't forget to subscribe to stay updated. Thank you for tuning in, and see you next time.